Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stennebeck on Bloomberg Radio.
For more with us on how the U.S. economy is doing, we've got a Bloomberg Economics U.S. and Canada economist, Stuart Paul. He joins us here in the Bloomberg Businessweek studio. So, Stuart, we are 1 week out from the last FOMC decision by the Fed this year. The data that we're getting now, the data that we get between now and then, will it do anything to change the thinking about an expected 25 basis point rate cut?
I don't think that it'll do anything to change whether or not we will get a cut. I think that the only thing that it can change is what the coalition of voters looks like. Basically, all of the data that we got today was pretty bad. We had layoffs, as reported by ADP in the month of November. We saw ISM services. Yes, it surprised to the upside, but it surprised because of slowing supply chains, like a very peculiar reason for ISM to surprise to the upside. We saw new orders that were weakening, employment that continued to decline in the ISM services report. We saw import prices that were flat, basically, so that gives a little bit of room for the Fed to consider cuts because tariff pass-through is slow. And the final thing that we saw was September's industrial production numbers, with manufacturing output basically flat. And so all of it just sort of points to this final Fed decision for the year, looking like it's going to be made by a pretty robust coalition. In my view, when we get the summary of economic projections in December, that's where I expect to see a lot of dissent and a lot of division among the committee.
You know, we've been talking to Joe Matthew on Balance of Power about USMCA, the trade deal that replaced NAFTA. You obviously follow the Canadian economy. I mean, in the past, this has been an important economy for the U.S. U.S. has been an important economy for Canada, excuse me. So how are you thinking also, too, about where trade is kind of settling between what has been really important trading partners for the United States?
Well, I think that the thing that's most important to remember from the Canadians' perspective in the context of USMCA is that Canadian negotiators are basically going to be waiting for the U.S. and Mexico to sort out trade and border disputes, trade and border deals. For example, how much security Mexico should be deploying to the U.S. southern border, before Canada actually gets to come to the table to discuss its own trade relationship. Right now, the average effective tariff rate on Canadian exports to the U.S. is in the low single digits, 3 to 4%.
So not really, yeah.
Because of how many carve-outs there are. And because of, the importance of the U.S. as an energy export market for Canada, all the energy just flows through the United States. Canada is right now relatively content just to wait. The bigger issue for Canada right now is dealing with pretty lackluster domestic output and domestic demand. The labor market has softened materially over the summer. It looks like there's a little bit of a glimmer of hope there. Right now, it seems as though, trade is sort of normalizing. Of course, the second quarter was really, really rough.
Yeah.
And so we saw an outperformance in the third quarter, but trade balances are starting to normalize, and any sort of negotiation is just going to be on hold until the U.S. and Mexico can sort out their differences.
Okay, so just a realistic timeline for what that could be?
I think that in earnest, we're going to start seeing some important talking points rolled out in the second quarter of 2026. Of course, any sort of negotiation can be sped up by, let's say, Prime Minister Carney visiting the White House. He's already been to the U.S. now, I think, twice so far since he took the leadership role. But right now, I'm expecting to see some more definitive deal points getting rolled out in the second quarter of next year.
It's just kind of wild. I thought we're not done with trade. I know we're not done with trade, but it just keeps, creeping back. One of the other things that we've been talking a lot about are retail earnings this week and over the last couple of weeks. Nation's retail companies continuing to report out earnings amid the holiday shopping season now underway. Stuart's going to stay with us. Want to get to, though, Tim, some of the earnings we got today.
Yeah, let's bring in Emily Cohn. She's Bloomberg News Consumer Team Leader. She joins us here in studio. So I'm a little confused about what's going on with Macy's because shares initially fell after the company reported earnings forecasts that disappointed investors, but now we're seeing them up 2%. What's going on with Macy's? What did we learn?
I mean, Macy's basically had a good report, solid lead up to the holiday season. I think the shares are volatile. I think the thing that brought shares down initially this morning was a disappointing profit forecast. And I think that speaks to, we had the CEO tell us this morning, a cautious consumer. So they're being, a little bit conservative with their forecast. I think that initially disappointed investors, but all in all, it is a pretty good report for the company. I think their stock's up 34% this year. So I think anything a little bit disappointing might pare back.
But an 8% swing from high to low is a lot.
It's a lot.
It's like a confusing investor or a confused investor, right?
Yeah, a little bit. Yeah. But I do think it comes on the backdrop of really strong performance this year.
Just throw Dollar Tree. They reported better than expected profit. They also raised their full year earnings outlook, and we saw that stock rallying in today's session. So a good report. And what does it say about what type of consumer?
Mm-hmm.
Yeah, for sure. I mean, this is the kind of store that does well in this kind of economy, right? They said on their earnings call they're seeing middle to high income shoppers trading down to Dollar Tree. That's good news for a store like this. And it continues to paint this picture that we saw last week and the week before, which is this split screen picture of how the consumer is doing. Consumers are still spending, but they're looking for value and they're looking for places where the price is right. And Dollar Tree definitely fits in that better category.
So Stuart, come on back in here and just give us your take on how the U.S. consumer is doing in the context of the retail earnings that we continue to hear about. To Emily's point, consumers trading down, higher end consumers trading down. That's good news in an environment such as this for a company like Dollar Tree. We had Dana Telsey in earlier this week, and she basically said, listen, if you're offering something unique to the consumer, like if you're a Levi's, for example, if you have a marketing campaign that is unique, you're still able to bring in consumers. How do you characterize the environment?
It's interesting when I read. So, of course, I think about the economy mostly from the top down, and I enjoy when I get to participate in a roundtable with somebody like Emily, who provides some insight about the broader economy from the bottom up. And what's interesting is when I see rotation to a lower end retailer like Dollar Tree, it speaks to the price sensitivity of consumers. And then when we look at some of the more macroeconomic data, we see that firms are struggling to pass through some of the costs of tariffs. A lot of firms are reporting that they're getting squeezed in terms of profitability. Again, this is when I zoom out to the macroeconomic level. We're seeing squeezed profits in the aggregate data because a lot of the cost of tariffs are sitting with those producers. When you have consumers that are especially price sensitive, it's just sort of a tenuous balance that you're walking in the economy. Now, it's no wonder why policymakers are going to be pushing for a rate cut, because you're hoping that looser credit conditions will help to alleviate some of the pressure that consumers are feeling so that you can continue to have that expansion. But right now, it's just characteristic of a sort of tenuous balance in the broader macroeconomy.
Yeah, I also feel like characteristic, and Emily, come on back in here, is that we are constantly hearing, even from retailers that do well, right? I think even Walmart, that there's like a cautious consumer out there. I mean, cautious consumers. So they're spending, but they're being careful. They're being cautious. They're making choices. They're trading down. Is that a fair narrative takeaway?
I think that's exactly right. And I think that's what we heard from Tony Spring this morning, where, Macy's generally, it's a middle to high income shopper, but around the holidays, they have more aspirational shoppers come in. Those are the people who they're seeing pull back, be extra cautious. And I think that's right.
So, before we wrap up, just kind of on the specifics, Emily, just real quickly, who else are we done from the retailers? And didn't we just have like a pretty impressive Black Friday and Cyber Monday?
We did. We had an interesting Black Friday, Cyber Monday. We don't really know the full results yet, and I think we'll see that. We have some more retailers reporting the rest of the week. We have Kroger tomorrow, Five Below, more
Ulta,
dollars,
right? Too, I think.
Ulta, exactly. PVH
today, yeah.
So we're still, the retail earnings season really never stops.
Yeah. All right. And then we'll get into the holiday results.
Yeah.
Emily, thank you so much. Really appreciate it. Bloomberg News consumer team leader, Emily Cohn, with the latest on retailers. Stuart Paul still with us, talking about economics. I mean, there's a lot going on, and I guess we are just so focused about the Fed meeting next week. Is it all but done? Another quarter point cut? And is it all then about what kind of color we get on 2026, and does it really matter? Because Fed Chair Jay Powell, we assume, will be on his way out.
Yeah, I think that the 25 basis point cut in December is a done deal. When I think back to October, we only had one dissent in favor of holding rates steady, and that was from Kansas City Fed President Jeffrey Schmid. So when, of course, the Beige Book came out, I was particularly interested to know what's going on in Kansas City. Is it possible that he would join the coalition of voters come December who would favor a 25 basis point cut? And Kansas City conditions looked quite a bit worse in the last Fed Beige Book. So I expect that there is this broader coalition forming for a December cut. You know that Governor Myron is going to vote in favor of more than 25 basis points in December. What's going to be a little bit peculiar, and we've seen this, we saw this last year in particular, is that when the summary of economic projections comes out with the dot plot, I would not be surprised to see other FOMC participants keeping their dots a quarter point higher than where we end the year. That's to say there are sort of shadow dissents among FOMC participants who are not voting, who would have preferred rates to not be lowered in December, even though the actual voters decide to lower by 25.
Explain why.
Yeah.
Because we have other FOMC participants who are not voters, and among those people are Cleveland Fed President Beth Hammack, Dallas Fed President Lori Logan, folks like that who are going to be voters next year, who were more hawkish in all of their public comments. They don't get a vote this time, but we expect that they would try to send a signal to the rest of the world, hey, we're not going to be moving at the same pace next year. And so when we see dots for 2026, I expect there's going to be a pretty wide distribution. I expect that the incoming cohort of FOMC voters from the regional banks are actually going to be quite a bit more hawkish in 2026 than they have been this year.
Are we nuts to be thinking, or for traders and investors to be assuming that Kevin Hassett is the next Fed chair? Because it does seem like all Fed roads are leading to him at this point.
It looks like that's going to be the case. It looks like it's going to be a Hassett nomination. President Trump was alluding to Kevin Hassett being the nominee when he had a press conference, I guess, just yesterday. There was a story from the Financial Times today that apparently in one-on-one conversations between bond market investors and the White House, some folks expressed concern. But then you look at the price action when the trial balloon was floated last week with Kevin Hassett's name, and he passed the financial markets test with flying colors. And so I'm less concerned about what folks are saying to the White House than what the market is saying to the White House. And the market is giving a clear go-ahead.
I don't want to put the cart before the horse, but if you're saying the market is giving the clear go-ahead, then what does the Senate confirmation process look like?
I think that what's different between, let's say, the Senate confirmation process for Trump's nominees this time versus in his first term is that I guess you could say the MAGA movement has coalesced and there is a broader coalition that is in support of President Trump's agenda. And so the division between the Senate Republicans, for example, and the White House is pretty narrow. There is not a lot of dissent among Senate Republicans in the White House. Every now and then you see somebody pop up like Mitch McConnell who has their own voice. But I expect that somebody like Kevin Hassett should make it through the confirmation process in the Senate Banking Committee pretty easily. And then it'll be mostly a party lines vote when it actually gets to the Senate itself, to the Senate floor. So I don't think that it's going to be an easy process. I think that it's going to be one where you're going to have some pretty dramatic headlines when he gets questions from, let's say, Senator Warren from Massachusetts. It's going to be a pretty ugly back and forth. But when it comes time to actually counting the votes, I think you just get party lines votes and he gets his shot, if that's what the White House ultimately decides to do.
And speaking of Senator, she's been outspoken. She wants lower rates.
Yeah.
That's right. This is always what's tricky is that sometimes political partisans find a way to make sort of funny bedfellows. And yes, she does want lower rates, but does it come at a cost of politicizing the Fed as an institution? I think she's going to try to make it more difficult for him, even though they both might want the same thing when it comes to policy.
It's just the Fed, all of it around the Fed. I mean, you had Treasury Secretary Scott Bessent today saying he's going to push for this new rule that regional Fed presidents must have lived in that district for the last 3 years. I just feel like there's just so many things going on. You're going to come back. We will continue the Fed conversation, but keep in mind, 1 week from today, we will have the last decision of 2025. Stuart Paul, Bloomberg Economics U.S. and Canada economist.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We promised you that we were going to continue on the U.S. economy and really the U.S. consumer. The online lending marketplace and platform for loans, credit cards, deposit accounts, insurance, and more. We're talking about Lending Club. They announced a $100 million share buyback just about 1 month ago. It was about nearly 5% of the company's market value on the day of the announcement. Now, analysts have been raising their price targets on the stock this year, most recently, again, raising them since the company reported earnings late October. The company posted third quarter results that beat estimates. They provided a guidance range for new fourth quarter originations with a midpoint above estimates, and the stock, it's actually up this year.
Yeah, it is. Shares of the $2.1 billion market cap company about 14%, up more than 12% since reporting those earnings back on October 22nd. Delighted to have with us Scott Sanborn, CEO of Lending Club, also CEO for close to a decade at Lending Club for 15 years now. Also with us here in the Bloomberg Businessweek studio, Herman Chan, Bloomberg Intelligence Senior Analyst for U.S. regional banks. He helped bring all of this together. Scott, I want to start with you and just give us some size and scope of the business, the consumers that you're working with, who's interacting with the platform.
Yeah, so we serve a customer base we call the middle majority. They are, if you think about credit, which we are a credit-centric bank, if you've got a lot of money, you don't need a lot of access to credit. You pay cash for a car, you save up to send your kids to college. If you're on the other end of the spectrum, you can't really access credit. Mm-hmm. So there's this middle group that are high income, heavy users of credit. So they can afford a car, they can afford to send their kids to school, but they need to use credit to do it. That's who we serve. It's a really big customer base. It represents about a third of the U.S. population, but it's close to half of the credit wallet. So they are more likely than average to have every form of credit. And that credit is, with the exception of mortgages, also larger than average. That's who we serve.
How much do these people usually make?
Our average, and obviously misleading, averages can be misleading, but average is about $125,000. But you can think of it of ranging between, call it $80,000 in individual income to about $200,000 is where we really over-index.
Great. One of the real highlights of your recent Investor Day last month was the panel discussion with marketplace investors, and we talked about this earlier before your appearance here on radio. One of the panelists talked about aligning performance expectations, partnering with better operators. Are you seeing that with the private credit space?
Yeah, we do. So, we were born as a marketplace. Initially, everything we originated, we sold. When we acquired the bank in 21, we started to hold a portion of our loans on our balance sheet. That both gives us a stronger and more resilient earnings profile, also allows us to do other things, innovate using our balance sheet. And what we found is just by aligning our interest with our loan buyers, we're the largest eater of our own cooking. We're the largest holder of Lending Club loans. We care very deeply about the performance of the credit. And, credit is always evolving. It's very dynamic. Because we have a balance sheet, what we can do is when we want to test something new, we test it on our balance sheet. Let's try longer duration. Let's try a larger loan size. Let's try a new marketing channel. We hold that first.
You own it.
We own it. We make sure it performs the way we expect, and then we release that to the marketplace. If you don't have a balance sheet, you can't really do that. And so that's visible in our results across every aspect of underwriting. So lower delinquencies than the rest of the industry, 30 or 40% below, lower roll rates, higher recovery rates, lower prepayments, lower fraud. Literally every aspect that you can measure of credit, we're outperforming on.
Has that remained consistent this year, in recent months, in recent weeks? Like, you have a great real-time view of the consumer in the form of how well they are doing in terms of paying back their loans.
That's right.
Still looking good?
Yeah, so that's been consistent for, we release 4 years of data we put out there, and so it's remained consistent. But, it's kind of like a duck on a pond. It's remained consistent because we're doing a lot of work underneath the cover. So, something that we shared at Investor Day is at any given time, we have more than 200 tests in the market where we're evaluating price points, changes to the credit. So we're constantly adjusting to reflect what's happening with the consumer. And that's what's giving us the consistent results.
Well, so that to me says you're very picky about who you lend to.
That's true. We are.
So in terms of your test, so tell me what it is. I mean, and how many of people who apply or want to access your platform, you're like, I'm out.
Yeah, so we're pretty good at selecting who we want to have in our portfolio and reaching out to those people.
Yeah.
And then both delivering the price and product experience, but also, let's call it the user experience that gets them all the way through. So we look for areas where, for example, we can control the use of the fund proceeds. If you come to me and say, I want $20,000 because I'm going to do whatever, my kid needs braces or I'm moving cross country, great. But unless I'm paying the orthodontist, I don't actually know that that's what you're using it for.
Yeah.
So we try to, set ourselves up so that we are in some ways controlling the use of proceeds and then making the experience such that it makes it really easy. So our largest use case is for people who already have debt, credit card debt, most notably, which at this point, more than half of all Americans are carrying. They're carrying it at really high rates, 23% interest rate. It's the highest they've ever been in history. And we say, great, you should do this instead. It takes less than 5 minutes. We're going to save you 700 basis points. Oh, and by the way, check all the credit cards that you have that you want us to pay off. Like we see you have Chase or a Cap One. Great, check those, and we're going to pay them directly. So we know you are paying off your credit card debt. You're not just saying you're going to pay off your credit card debt and taking out more money. We are paying it off for you. Benefit for you is, you've consolidated everything into one bill. Other benefit is your FICO score usually goes up by 30, 35 points because you've lowered, your utilization.
How much can you lower? Like, I got to tell you, credit card rates just blow my mind about how high they are. And I'm just curious, why are they so high? Are people so bad? Is it to cover? No, I'm curious.
Yeah, no, it's a great question.
I mean, it just seems like it's out of control. And I think it prevents people from becoming financially solvent or creating, kind of getting ahead of the game, if you will.
Yeah, there's a lot to unpack in that.
Sorry.
It is, no, it's a great question. And, there's a number of questions underneath, but I'd say the biggest thing is, if you think about how people choose credit cards, it is not based on the interest rate.
Yeah.
Right? It's my Sky Miles card or my retail store card. I'm going to get rewards for this. They don't even know what the interest rate is, or it's a promotional rate that resets. So that's one. They don't choose based on that. Half of the people don't revolve on the card. They're collecting these rewards, but they're not carrying a balance. Well, guess who's paying for that? All the people that are carrying a balance. Those people don't know what their rates are. The research we've done is half of all customers don't know the interest rate on their credit cards, and the half that say they do, more than half of them are wrong. Right? Wow. They think they know their rate, but they don't.
Right.
And so cards have been able, and one of the big resets with the cards was driven by the Card Act, which limited how much cards could increase rates. So they factored in higher rates.
I just want to jump in real quick. We are speaking with Scott Sanborn, CEO of a lending club. He's been CEO for close to a decade. We're also just getting some breaking news, too, on Apple. Apple's design executive, Alan Dye, poached by Meta in a major coup. This is the most prominent design executive at Apple. This underscores a push by the social networking giant into AI-equipped consumer devices. We also have here with us Herman Chan. He's Bloomberg Intelligence senior analyst for U.S. regional banks.
Thanks. I wanted to follow up with you, Scott, on some of the medium-term expectations you laid out at Investor Day. You talked about doubling loan originations. We're talking about $18 to $20 billion a year. What are some of the levers to get you to that level? You mentioned use cases. Maybe talk about home improvement as a use case, and how do you maintain solid credit quality as you ramp up that volume?
Home improvement is something you're getting into, right?
That's right. Yep. First and foremost is, as I mentioned, credit card, refining people out of their credit card debt into a fixed rate, lower rate loan is number one use case. It's about 80% of what we do. That market is the largest it's ever been. There's 1.3 trillion in credit.
80% of what you do is that. Wow.
Yeah.
Go ahead. Sorry.
That is, 1.3 trillion in balances priced at really, really high rates. We, when the rate environment shifted and the inflationary pressure shifted, we pulled back on a lot of our marketing. So we're currently running today at sort of below our historical volumes. So we're just going back into that market, turning back on marketing channels that we had turned off. And then the other areas, personal loans can be used literally for anything, right? And before credit cards came around and came to be, they were the dominant way consumers accessed, credit for everyday needs. So we have a major purchase finance business that's growing today, call it 50+% year on year, that's allowing things like elective medical procedures, LASIKs, braces for your kid, all kinds of procedure, fertility treatments, teeth implants. So things that insurance doesn't pay for, but you want to do and you want to do right away. Private school education, that's another one. So home improvement is sort of a next adjacency. People right now are staying in their homes longer. 75% of Americans, their mortgage rate is under 5%. They're not going anywhere.
Right.
And the homes are getting older. So the homes need to be invested in. They need to be improved. So effectively enabling home improvement through an unsecured loan where, again, we are controlling the use of proceeds. We can pay the supplier. We can pay the contractor. We've got the capability through an acquisition we announced to, disperse this in phases to multiple parties. So we're really excited to kick that off.
We've only got like 30 seconds left here. Consumer doing okay?
I'd say the consumer we serve is demonstrating themselves to be remarkably resilient. Despite,
I hear that a lot. It's a drinking game now.
But we'll acknowledge the sentiment isn't great.
Okay. Yeah. Come back soon. I have to tell you that I think we're all like, I want to go. Please come back late because I think you have a great vantage and view into what's going on in the economy.
We'd love to.
Okay. We would too. Scott Sanborn, Chief Executive Officer of Lending Club, our amazing Herman Chan, Bloomberg Intelligence Senior Analyst for U.S. Regional Banks.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
If you've been listening or watching us the past couple of days, we've spent a couple of days talking about residential real estate. We did that with Ron Eliasov, founder and managing director over at Northwind Group. And then yesterday with Louise Phillips Forbes of Brown Harris Stevens. Our focus with them, really what's been happening in New York City and what will happen in New York City. We want to take a different look, another look at a different type of real estate and kind of go further afield. Back with us is Amy Rubenstein. She's CEO of Clear Investment Group. It's a Chicago-based firm that specializes in opportunistic real estate investments, specifically in the distressed mid-sized multifamily sector in mostly secondary and tertiary markets around the U.S. She joins us once again here in our Bloomberg Interactive Brokers studio. Welcome back.
Thank you so much.
So it has been a little over a month since you were last with us. It was actually during the government shutdown.
Yes.
A lot has happened since then. We've gotten some data. We've gotten some delayed data. An update on just how things are looking in your world and remind everybody what markets you focus on.
Yeah, we're seeing definitely two ends of the spectrum right now. So we are seeing some struggles that operators are having. I guess what we're really looking at
More
is...
so than 2 months ago?
Well, not so much more so than 2 months ago, but we're
Okay.
really feeling that K-shaped economy that everybody's talking about, where some of these lower income tenants are struggling a little bit on expenses. We are still feeling inflationary pricing, and we're feeling a little bit of a lack of labor. And I think that that is something that is starting to grow, is really looking more towards where does this construction labor come from? And I think that's a product of deportations and a product of not having a great immigration policies right now.
What are you thinking?
Yeah, I was trying to remember who I was talking to about this just in the last couple of days, talking about how they are having a hard time finding people to do the work right now.
Yeah, construction is a little bit tough.
So what type of construction specifically?
So
Because we talked a lot about
any kind of rehab, any sort of, it could be anywhere from ground up construction where developers are struggling a little bit on prices, both from inflation and also from lack of labor, and then also just on the rehab in general.
That
Just
lack of
turning
labor
units.
is really because of immigration. No doubt about it.
That's what we're seeing.
Yeah.
We're seeing it. A lot of people don't show up to work, even if they do have legal status. People are a little bit scared. On the flip side, you are seeing incredible opportunities right now for investments because there is a lot of distress. We happen to be buying a lot right now. We're in the middle of a fundraise on a fund because there is so much to buy.
There's opportunity.
So much great opportunity out there and not a ton of competition because right now lenders and investors are really not pricing in pro forma. They want in-place cash flow, in-place NOI. And if you can find stuff where the fundamentals are strong, but the NOI is fixable, but not quite there, then you really have a great opportunity for buying.
Michaela in our control room, one of our producers, reminding us that just a couple of weeks ago, we spoke to Christina Stembel of Farm Girl Flowers.
Yep.
And they bought a farm to grow flowers on a small portion of their flowers. But
Right.
she said they were hearing about a hard time with labor.
Right. And we know that, right? The
Yeah.
farm industry is another one. You mentioned NOI, net operating income. Help me understand something though. When you are finding lots of opportunities because there's distress out there, it's when things aren't going so well, that's actually a good environment for you guys? Or
True.
what?
And I will say,
is there a little bit of a balance?
There's different kinds of distress.
Yeah.
You feel some people that are really being strained by higher interest rates, by higher expenses, by higher delinquencies. And so you feel some strain. And what that could cause is definitely some pricing adjustments as people are trying to sell. I do think, as you were talking about before, interest rates are going to start to give a little bit of wind to cap rate compression. And so you'll start to get buyers and sellers coming together more. But that's not the type of distress that I'm talking about. I'm talking about distress that's even deeper than that, where operators maybe didn't have a lot of experience and overextended themselves. And so there's more to it than just that. There's layers of distress there.
How are tenants doing?
So I think that, I think we see a little bit of both ends, right? We're back to that K-shape where you see the higher end tenants doing very, very well. And you see some of your lower income tenants that are struggling a bit more.
Is it manifesting in the operators needing to offer concessions? Are you seeing delays in rent? What are you seeing?
So we've tried to start getting creative on different ways to help tenants keep up with their rent and help them with budgeting, teaching budgeting classes, trying to pull out their rent in different stages during the month as their paychecks come in. So to try to help keep people on track a little bit.
It's fascinating. We just had a long, deep conversation with the CEO of Lending Tree, and the same thing. Am I saying it right?
Lending Club.
Oh, Lending Club. Sorry, Lending Club. Forgive me. Lending Club. But the same thing in terms of when they are giving loans, like they want to know where it's going, and if it's to pay off credit card debt, they will make those payments directly, and really kind of teaching some financial responsibility. And how big a part of that is what you guys do?
It's really interesting because this is a new trend for us. This
It
wasn't
is.
something that we were doing 5 years ago, helping tenants learn about budgeting and finances. And it's something that now we're starting to really look into. How can we be partners with these tenants as opposed to the people that are forcing them to pay their rent?
Why are you doing it? Is it just business sense?
It's
or-
a win-win for everybody.
Okay.
If people can prioritize their finances and get their rent paid and stay in their houses, it's better for us. We don't lose the income. We don't have to go through evictions. It's better for them. They don't have to be relocated. So it's a win-win for everybody. It's a matter of can that have an effect? Can we be effective enough to help shape that?
Do the tenants feel like they're being partnered with? I mean, there's this idea of an adversarial relationship when it comes to landlord and tenant.
Sure, I think there can be, and I think you get a little bit more of that in places, I would say a place like New York, where you've got rent control and the landlord and the tenant are not really aligned because they're not both choosing that rental rate.
I can think of some landlords I've had in my day where I was not completely aligned with, Carol. What about you? That would be a way to...
Anybody who's lived in New York.
You know what's interesting? Of all the places that we rented, that I rented in New York, one landlord who was good.
Really?
Yeah.
But nobody ever talks about their good landlord.
Out of four.
Out of four.
Yeah.
What?
Yeah, that was pretty good. 25%. That's not bad. She was unique.
Okay.
Yeah.
Well, see again, unique.
Yeah.
Your properties, remind me, because I think initially you guys were in Chicago.
We're based out of Chicago.
But
right now we have properties in Ohio, Louisiana,
a lot in
Alabama.
California.
Not anymore.
Not anymore.
There just is not cash flow in California. It's a little more like New York City, where everything's just based on appreciation.
Will you, if California builds more, would you go back?
We look for stabilized cash flow, not for incoming cash flow. We actually don't care about the NOI in place when we purchase things. We actually look for negative NOI because we want to be able to fix that NOI, and that's how we add
better
that value.
opportunity, right?
But we want to eventually get to strong cash flow.
Best places in terms of geography right now for you guys?
I think there's tons of opportunity in Atlanta. We keep looking over there. Lots in the Midwest. We love it. We love Ohio and Indiana. Right now, we're buying in Alabama. We have a deal under contract in Illinois.
Where in Ohio?
We're in Columbus.
Okay.
We really like Cleveland as well. So there are people are looking a lot in Cincinnati. There's lots of places to go there.
I know we talked, we go kind of all over with you, but when we talk about affordable housing, what is the answer? Which is something that we have talked about for decades.
Right.
What do you think is the answer? And forgive me, I'm only giving you about 40 seconds. Solve a problem that has plagued
I think
us for a
different
long
markets
time.
are going to have different answers.
Okay.
I think generally speaking, it's easier for us. We see a better opportunity in rehabbing and rehabilitating as opposed to ground up construction where you need a lot of government subsidies or some sort of incentives to be able to get it done. For us, we see the opportunity in existing assets that just need a lift back up. But then again, you got to be willing to buy something that's a negative cash flowing in the beginning.
And most of those assets are going to be outside the major cities or in the major cities?
Not necessarily.
Okay.
We own in DC.
Yeah,
so it can be all over the place.
Great stuff. Thank you for coming by again.
Thank you for having me.
Right? We love real estate.
Amy Rubenstein, CEO of Clear Investment Group.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.